Today we're going to take a look into the operations of a business, Emily's Bakery. Now, Emily's Bakery runs 8 a.m. to 5 p.m. 6 days a week, and thus it is evident that businesses operate during a period of time and not simply a point in time. Hence, entries must be adjusted at the end of the accounting period in order to accurately record revenue when they are earned and expenses when they are incurred, satisfying both the revenue recognition and matching principle. There are 4 categories for adjusting journal entries: prepaid expenses and unearned revenue, known as deferrals, and accrual expenses and accrual revenues, known as accruals. Now let's start with prepaid expenses. Prepaid expenses occur when a service or good is paid in advance. For example, on the 1st of March, Emily paid 3 months' rent, equating to $3,000 for the current month of March, and the subsequent 2 months, April and May. A financial statement was prepared on the 31st of March. Upon the preparation of the financial statement, 1 month had passed, and thus 1 month's worth of rent is transferred from prepaid rent to rent expense. Hence, $1,000 is debited to rent expense and credited to prepaid rent, reflecting an increase in rent expense and a decrease in prepaid rent as time passes. Sometimes Emily will be asked to cater for corporate meetings, receiving payment in advance. This is what is known as unearned revenue. In this case, a customer pays Emily $3,200 for 4 months' worth of catering ahead of time. A financial statement was prepared on the 31st of March. To record the adjustment, we must first calculate 1 month's worth of service that Emily has provided. By dividing $3,200 by 4, we get $800. Since we are decreasing the liability and increasing the revenue, $800 is debited to unearned revenues and credited to service revenue. Now onto accrued expenses. Accrued expenses are expenses that have been incurred but have not been paid for. For example, Emily pays her staff every Friday, paying a total of $3,000 per week. A financial statement was prepared on Tuesday the 31st of March. Since she pays $3,000 each week, she spends $500 on salaries each day. Moreover, since they worked Saturday, Monday, and Tuesday, 3 times $500 equals to $1,500. Hence, $1,500 is debited to salaries expense and credited to salaries payable. As a result, liabilities are increasing and equity is decreasing. Last but not least, we have accrued revenue that has been earned but not paid. Emily bills her customer $225 for catering provided on the 27th of February and receives payment on the 21st of March. A financial statement was prepared on the 31st of March. To record the adjusting entry, you debit accounts receivable and credit service revenue $225, resulting in an increase in both assets and equity. Hope this screencast has assisted in unlocking the skills needed for adjusting entries.